If you're going to trade, you don't want to do it like they do, short-term trading. You've got to go the other way. You've got to take advantage of the opportunities, longer-term opportunities, because to do short-term trading and go up against Jim and his colleagues is just folly.
Welcome back to another episode of our podcast. Our guest today is Gregory Zuckerman, who is an investigative reporter and special writer at the Wall Street Journal. He has expertise in hedge funds, private equity, and credit markets, and is the author of the book, The Man Who Solved the Market, How Jim Simmons Launched the Quant Revolution, which is today's topic on our podcast. Thank you so much, Greg, for joining us.
Sure, pleasure to be here.
In your book, you write, since 1988, Renaissance's flagship Medallion hedge fund has generated average annual returns of 66%, racking up traditional profits of more than $100 billion. No one in the investment world comes close. Warren Buffett, George Soros, Peter Lynch, Steve Cohen, and Ray Dalio all fall short. End of quote. So, is Jim Simons the most successful investor of all time, and how did he manage to get these insane returns year after year for decades?
Sure. So it's a good question, because is he an investor? Is he a trader? Is he a speculator? I don't think I'd call him an investor, given that his average or his firm's average holding period is about 2 days. They call it internally moments to months, seconds to seasons. So I'm going to call that an investor, but more moneymaker, I call him. I mean, they are the greatest moneymaker in history. And it's because of the returns. The returns are better than anyone in terms of their average annual gains. As you said, 66% a year, which is just incredible, staggering, and really kind of unbelievable. It's spawned all kinds of doubts and people who think there's some sort of Ponzi or scam going on. And I spent a lot of time working on the book and don't believe that's the case. So he is, going to go down in history as the greatest moneymaker Wall Street's ever seen.
In your book, The Man Who Solved the Market, and you say, the Medallion increasingly was relying on strategies that its system taught itself, a form of machine learning. The computers, fed with enough data, were trained to spit out their own answers. A consistent winner, for example, might automatically receive more cash without anyone approving the shift or even being aware of it. So did Renaissance Technologies basically create the first AI trading bot in the 1980s, maybe close to 4 decades ago? Are they way ahead of the ChatGPT curve and everything else?
It's a really good observation. So we're all excited about AI today, obviously. But the origins go back decades, and they are among the first that I can determine, if not the first, on Wall Street who turned the decisions over to the computers, to the systems. And yes, the system was putting money into trades that the executives, the traders, the individuals at the firm, Jim Simons and his colleagues, weren't really sure why they were doing those trades. Now, to be fair, they would put the money on those trades automatically, but then go back and try to figure out why the system was making these investments, these trades. They were curious and they did want to understand why, but they didn't have to know why. They were putting money on trades that their computers were identifying by inhaling all of this data and looking for patterns. And that's the key to this whole thing. Renaissance, in the Medallion Fund in particular, they look for patterns in markets. In some ways, they're much, much, much more sophisticated technical traders. And these are patterns that you and I never thought about, never detected. Most people haven't. And they'll play those trades, even if they don't necessarily make intuitive sense. So it's systems rather than stories, the way I look at it.
Yeah, maybe we should take a step back here. Who is Jim Simmons? I mean, he's got a pretty interesting background. I mean, the guy's a MIT mathematician. He was a code breaker for NSA. Can you kind of who is this guy?
Yeah, he's a fascinating individual. Jim Simons grew up in Newton, Massachusetts, outside Boston. He's a mathematician. He went to MIT, taught at MIT, taught at Harvard, got a PhD at Berkeley. and spent some years in academia. And then he left to break code, go up against the Russians during the Cold War, and was building early algorithms there, matching wits with the Russians, and did some really interesting work. I write about it in the book. And then he left to run SUNY Stony Brook's mathematics department, was a successful academic, both leading that department, but in his own math too. He's a geometer, does geometry. He goes down in history as among the most important geometers of the last 100 years. His work is still relevant to people in that world. And then he said, you know what? And this is 1978 we're talking about. I'm going to go try to figure out the world of investing, trading, and see if there are patterns that people aren't aware of that I can make money on. And he spent years working on it, and he met frustration for years. I was kind of surprised, given these returns and his reputation on Wall Street. I thought kind of the super smart guy would have figured it out quicker. But even by 1992, again, from 1978 to 1992, he was close to giving up. He had made progress in things like bond trading and currencies and commodities, but he really wanted to become really wealthy, worth billions. And the only way to really do that is in a bigger market like equities. And he couldn't figure out equities for reasons I detail in the book, but essentially he figured out ways to make money, signals that worked, but they couldn't make enough money. They couldn't figure out why, and part of it was their impact on the market. And they finally realized that it's not enough just to figure out good signals, good trading approaches. Your trades may impact the market in and of itself such that it weighs on returns. And they had all kinds of issues with equities. And frankly, Jim Simons identifies talent really well. So not only is he a geometer and a mathematician and a quant, and he builds algorithms, he can do the math side. He's really good at finding talent and luring the talent. Maybe that's a bad way of putting it, but encouraging the talent to join the firm, creating incentives, figuring out motivations. He's great at that. So he can do both sides. He's a guy who can do the math, and he's a quant, but he's also a guy you can have a conversation with and have a drink with, or smoke. In his case, he's a chain smoker. And Jim was able to find the right talent, and there were a bunch of people from IBM that I write about in my book who figured out the equity trading, and the rest is history. But it took them years to figure it out.
Yeah, in the book, you kind of allude to the fact that Jim Simons basically was this mathematician, and then he built this department at Stony Brook where he was pilfering other elite Ivy League schools of their professors. And then when he went from academia to starting his own hedge fund, a lot of his colleagues looked at him as like weird. It's like, why would you want to go make money when your true calling in life is doing math? That was really in the 70s and 80s, but now it seems like the brightest, the smartest people really just go right to Wall Street because that's where the money's at. Has that been like a cultural shift? Or, I mean, it just seems like the smart people today just jump right into finance, where back then it was like, oh no, like solve these weird math problems.
Yeah, so some of them thought he was weird. Other people just sort of looked down on him. Here he was giving up this storied career in academia. He was making progress. He was among the best. And he was giving it up to go work like a little strip mall in Long Island next to a pizza shop. I went there and visited it in the middle of nowhere. So he gave up all the prestige of academia to try and beat the market. It seemed beneath them, beneath these mathematicians. And frankly, it seemed beneath a lot of the mathematicians that Jim Simons convinced to join his firm. So the way he kind of portrayed it was, join us not so much to make a lot of money, but to tackle a problem. And you, I'm sure, and a lot of your audience realize that investing is intellectually challenging and fascinating and enjoyable, but a lot of academics don't always see it that way, or didn't see it that way. So Jim had to convince them, well, it's not just about making money, guys. It's the most challenging problem you could find. You like chess, you like other kinds of Go, you like other kinds of challenging games. This is a challenging game, the markets. And that's how he convinced a lot of them to join. And then once they got there, they started making money. And then money has a way of just embracing people, and people find it hard to let it go. So once they were there and they were making money, it's hard to quit that, to give that up. But yeah, as you suggest, back then it was beneath a lot of mathematicians to embrace the world of finance. Today it's a little different, and every Wall Street firm, when I get a tour, they kind of point to, oh, there's our PhD, or that corner is our group of PhDs, and mathematicians and scientists are hired left and right. But it's a different world. The irony is that Jim Simons, early on as a kid, said to his family doctor, oh, I think I want to go into math. The doctor said, you're making a foolish decision. You can't make a living in the world of math. And today, you have a heads up on everybody else in the world of finance and everywhere else, if you've got a math background. Or data, for sure.
You mentioned that you met Jim Simons, and he's a pretty private guy. I mean, what is he like? And were you at his house, and did you go on his yacht? Where did you have these meetings with him? And what is he like in real life?
We met in his office in Midtown Manhattan, or Lower Manhattan, and for a few hours each time, and that meant spending a few hours with smoke fumes in my face incessantly and constantly, because he's a chain smoker. He's a fascinating guy. He knows the numbers. He's a mathematician, a preeminent mathematician, and yet he's beat the odds because he's been a chain smoker, and he's in his 80s, and he's sharp as a tack and physically pretty fit. And he realizes he's an exception there. He's a very private guy. He didn't want me to write the book. Even when it was at the printer, we had one last conversation, and he kind of said, Greg, I really want this book. Can you not write it? I'm like, Jim, it's being printed as we speak. It's a little too late for that. So he, I think, over time realized that I wasn't going away, and that it's probably better to talk to me than not talk to me. So I think that's part of why he did talk to me, but he also didn't want to tell me any secrets, and he didn't. So I had to get all of those from other people who work there today and people who worked there in the past. And that was really challenging.
Do you think he's afraid that other people will figure out his formula, or what's the reason for his secrecy?
So it's funny you say about formula, because some people have read the book and they've said, Greg, I really enjoyed it, but I was disappointed because there's no formula in there. What's the secret formula? Even some sophisticated people have said that. Most other people realize that there isn't any one formula. And frankly, even if there was, markets change, markets evolve. So even people internally say, yeah, they have some signals that have worked for years, but most of their signals have degraded over time and they have to constantly be replaced. So even if I identified a single signal or formula that worked, by the time I printed the book, it probably wouldn't have worked anymore. So they're a secret. And frankly, I do regret not. It's in the book. It's throughout the book, but I should have had a page or two laying out. They have a series of secrets, and each one has help. Part of it is identifying unique data, cleaning data, using leverage, identifying talent in different ways than everybody else, having talent work together in better ways than everybody else. But there isn't one secret. And so getting back to Jim, yeah, he was afraid that I would, any more information about the firm risks reducing their advantage. And they've got this gold mine. They don't want to give that up.
One of the things I noticed in the book, the title of it is The Man Who Solved the Market, how Jim Simons launched the Quant revolution. But he had a massive team. Isn't there close to 300 people that work at Renaissance Technologies now? He really assembled a team of PhDs and various subjects, including mathematics and linguistics especially.
Yeah, so Jim contributes a lot to their success, contributed a lot, continues to some extent, but it's the team as much as it is Jim. I frankly think the book, and I only realized this after I had finished the book, it's as much a management book as it is a trading or investing book, in that among his secrets is his ability to get talented people to work together. And someone explained it to me who worked there, said Jim's genius is managing genius. And you don't think of Jim Simons, a the preeminent quant, as a manager, but that's among his greatest skills. So as you suggest, the book says the man who solved the market, and Jim does get the most credit. He built the firm, hired a lot of these people, decided that we should use a quantitative approach. And he went back and forth. He tried other kind of things. And he was a traditional investor using his intuition and his research for years. And sometimes he made money, sometimes he lost money, got physically sick from the experience. And that's why he switched over to be a quantitative approach. But yeah, I wanted to highlight those who contributed to the success. And there's so many fascinating, quirky, odd, almost headstrong, stubborn scientists, mathematicians, others who should get credit. So I wanted to give them their due credit in the book.
I've read a lot of different finance books, and I've read Warren Buffett's biography. And when you read like Warren Buffett, I mean, he bought his first stock when he was 12, and he just kind of locked himself in the office and read 10K forms and annual reports. And that to me seems like the average person could use that approach and it's applicable. But Renaissance technology, hundreds of employees, they were scraping data before other companies even knew what data collection was. They have so much data. And now, like, the currency of the modern world is data. I really enjoyed your book, but I'm like, I don't think there's a single thing that I could implement. Maybe with the exception of the, tax optimization strategy, which is a polite way to say offshore your cash, but
yeah. So as an author, you focus usually on the criticisms of your book, not the compliments. Compliments go in one area, go off the other. The criticism you focus on, and that's the other criticism of the book. Well, I want to be like Jim, and I can't do what he's doing. So, why don't I read the book? And there's some argument there. Partly, I wanted people to understand what they're up against. So I'm not saying you shouldn't trade for yourself. There are ways to do it. But you got to be aware of the competition, and Jim and people like Jim are the competition, so that if you're going to trade, you don't want to do it like they do, short-term trading. You've got to go the other way. You've got to take advantage of the opportunities, longer-term opportunities, because to do short-term trading and go up against Jim and his colleagues is just folly. So that's one takeaway, I think, for the average investor, too. But I think there's also something to be said for the principle of having a system and not winging it, not using your intuition, not using your judgment. And that's one of the important lessons, I think, from the book. And it doesn't mean you have to be a quant. It doesn't mean you have to have hundreds of PhDs like he does working for you. But you need to have a system that you rely on, and that when there's a crisis, we all tend to panic and we get greedy when things are going well. All the behavioral economic principles that we've read about and where we succumb to as individual investors, the way to avoid that or try to is to have some dedicated system. And it's not just in investing too. In life, when you look at pilots, you look at surgeons, they've got this checklist that they rely on. So in other words, you don't think of a pilot or a surgeon as a quant necessarily. We don't turn those decisions over to computers, but they're informed by this systematic approach. And people like Michael Bloomberg and others kind of have embraced it. And the irony or the frustration actually for me as an observer is that the president of the United States, the Federal Reserve, to some extent, they're still making their decisions like they did decades ago, and just start kind of winging it and using their judgment and reading the tea leaves and things like that. And one of the lessons from the book is that the most important decisions in life should be made with some systematic approach. If only a checklist where before any decision, you're going through XYZ PDQ kind of thing, and you're not just using your intuition, because we all think we're great judges of character or of situations. We can pick up the newspaper and see where currencies are going. We're not as good as we think we are. I'm not saying everyone should be a quant. I'm not saying you should invest in that way, but they have an approach in which they're not using the seat of their pants. And I think that we all need to embrace that to some extent, even if we're more traditional kinds of investors.
How would you define a quant? And then what would be the difference between a quant and Warren Buffett, or just more of a traditional investor?
A quant is somebody who defers to their computer. It doesn't have to be entirely so, but they've got some system. It's interesting, like Ray Dalio and Bridgewater. I don't think of them as a quant, but some people do. They do have a systematic approach, but it is individuals. It is a group of individuals making decisions. So some might call that a quant. I'm not sure I would. There are broad definitions. And, AI, same kind of thing. What is AI? It's people have this generic term for AI. Same kind of thing with a quant. But it's somebody who kind of relies on computers to some extent to make decisions as opposed to individuals and intuition. Listen, even at Renaissance, this firm I wrote about it in my book, it's not necessarily man plus machine, but it's machine plus man. Even they don't turn everything over to the computers, and they're the preeminent quants. So you're deferring to the computers to some extent. You're using data. We used to call it big data. We don't use it as much, but they, like you said, we're collecting data before anyone else, cleaning it out, cleaning it. And they were at the forefront, and they still are. Any kind of piece of data you can think of, they've purchased it. They've analyzed it. Let's say it's, I don't know, the activity in shipping docks in Bangkok or something, or Singapore. They've bought that data and correlated and figuring out their correlations, and et cetera. So I'm not sure I've answered your question entirely, because there's no kind of one perfect definition of you being a quantitative investor, but it's someone who doesn't use their intuition and their judgment as much as they defer to systems and in computers.
In your book, you write, in recent years, Renaissance has been scoring over $7 billion annually in trading gains. That's more than the annual revenues of brand name corporations, including Under Armour, Levi Strauss, and Hyatt Hotels. Here's the absurd thing. While those other companies have tens of thousands of employees, there are just 300 or so at Renaissance, end of quote. Levi Strauss, Under Armour, Hyatt Hotels actually provide good-end services to society. What is a trading firm like Renaissance Technologies, which isn't even open to outside investors in their Medallion fund, what do they provide to society? What do they contribute?
It's a great question. They would argue that they help make markets more efficient. I would counter that by saying, yes, traders in general do. I mean, you can make the same argument. What does an investment banker do? What does a trader do? Investors, for that matter. And yeah, we need, if you believe in capitalism as I do, you need efficient markets. And for there to be efficient markets, you need smart people making smart decisions in the markets. And they help do that. Now, are markets efficient? They're not. I would argue we still have crazy markets and things go to absurd prices in different directions. So things aren't entirely efficient. And do we need Renaissance there? If you took out those 300 PhDs, if they were curing cancer, they're providing more of a service to society than being at Renaissance. But I don't think they're doing harm to the world. And they do a lot of good often with the money they make. And that's another thing they would argue. And I would generally concur, or sometimes concur. So take Jim Simons, for example. He's one of the biggest, if not the biggest, funder to autism efforts, to cure autism, come up with drugs and treatments for autism. He's underwritten salaries. He helps subsidize the salaries of teachers, math teachers in the public school system in New York. There's value there. He does all kinds of scientific research, his foundation does. So he's worth about $27 billion or so, and his foundation is among the biggest in the country. He also is very politically oriented. So those who are Democrats would be thrilled with the fact that he's given money to people like Hillary and Clinton and Joe Biden. He's among the biggest backers of Democratic politicians. And some on the right would be thrilled that his colleague Bob Mercer is among the biggest backers of Republican politicians. I mean, Bob Mercer, a senior executive I write about in my book, I would argue is the most important reason why Donald Trump won the White House. This guy, Bob Mercer, helped install Kellyanne Conway and Steve Bannon in the Trump campaign, and that stabilized Trump and saved him. People on the left would say that's among the reasons why firms like Renaissance shouldn't be around, because he did help put Trump in office. So it's a complicated question, and you can make the same argument about traders and investors in general. And do I think there's a lot of wasted talent, brain power at Renaissance? I do. I mean, I wish, frankly, those PhDs in math and elsewhere were in science were devoting themselves to curing cancer. But again, a lot of them do really good things, and a lot of them make so much money in their careers at Renaissance that they go on and do really fascinating things. I can think of a lot of ex-Renaissance people who don't go and work on Wall Street. They rarely do. They usually go back to academia in science, foundations, and nonprofits. So it's a complicated question.
I find it interesting with Renaissance. Every year they basically cash out the fund because they don't want the fund to get too big. And that's, to me, like the really interesting thing with Warren Buffett and Charlie Munger is that they have a massive fund. He's still able to make money kind of year over year. He has so much money he can move markets by himself. He's kind of trading against himself. What's the maximum amount of money that the Medallion Fund has? How much money are they actually managing on a yearly basis?
So the argument or the counter argument to when I say Jim Simons is the greatest moneymaker in modern financial history, people will say, well, look at Buffett. Yeah, he doesn't have the same returns as Simons, not close, especially in the last few decades. They're pretty relatively mediocre. People will say, well, look how big Buffett is. How can you expect him to have those kind of returns? He's managing such a big corporation. And, if you get a 10% return on a $400, $300 billion market cap company, that's even bigger. But I would say that's why Jim Simons returns money. That's why he keeps his fund as small as it is. I mean, it's not tiny. Right now, it's about $15 billion. Historically, the Medallion Fund's been about $10 billion. At one point, it was smaller. He wants to get good performance. He wants to get great performance. He'd rather get a 60% return on $10 billion than 10% return on $300 billion. So they're different approaches. I'm not going to suggest that Warren Buffett is one of the greatest investors in history. But yeah, Jim Simons wants to keep the fund small, relatively small, or smaller than it could be. And he'll give up size in exchange for these returns.
What do you think the average IQ is at Renaissance?
It's damn high. It's higher than I'll ever get to. That's for sure. These guys are brilliant. They're also interesting. A lot of quirky, fascinating people. They're a mix of individuals. Some are Republicans, some are Democrats. Some believe in capitalism, some don't. It's the crazy thing. What I find remarkable, such a paradox, is that I love markets. I've always loved markets. Investing, trades, the history of trades, how a thesis is developed and expressed. They don't. They generally speak, some of them do. Jim does. But most of the people there could care less about investing. They're theoretical mathematicians. They're physicists. They're into science, geometry. They don't care about markets and history and Peter Lynch and Warren Buffett. It bores them. They just like making a lot of money, and they like the challenge of beating the market. They're brilliant, and they've got just very interesting interests, and they're just not the kind of people you would have expected to have beaten the market. You would expect people who actually care about markets to beat the markets. They don't really, and they spend a few years there, then they go back to math and Stanford and the halls of academia. It's just a very interesting group.
Yeah, I thought it was interesting in the book where you're talking about long-term capital management, which also had a bunch of PhDs. They had PhDs really in economics, and they imploded. They lost, $1 billion in a couple months, and then they ended up basically getting shut down. Jim Simons, he had a bunch of PhDs, but he didn't really get any PhDs in economics. What does that say about economics as a whole? And then what does it say about the similar approach, but not similar, and just vastly different results between long-term capital management and the Medallion Fund at Renaissance?
Yeah, some people have said, well, hey, Greg, you're such a fan of these PhDs. Look at what the PhDs did at long-term capital. And as you suggest, it's a different kind of PhDs. They're PhDs in economics. And you would think the PhDs in economics would do a better job investing than the PhDs in physics. What does that have to do with markets? It says something about markets. Markets, the more I do these things, the more fascinating they are. Even the people at Renaissance, one of the lessons of Renaissance is that there are a lot of inefficiencies in the market still. And yet, you could also go the other way and say it's pretty darn efficient market, because even Renaissance only profits from about 51% of its trades, barely 51% of its trades. They're like a casino almost, where they make a lot of trades, and if you can make a lot with a lot of leverage and you're successful 51% of the time, you do fine. But you can go the other way and say one of the lessons of the Renaissance experience is that markets are pretty darn efficient. They're not completely efficient. That's why Jim Simons can make 66% a year in his firm. But for you and I, they're pretty efficient. And yeah, getting back to long-term capital, there are a lot of lessons. I write about it in the book. But one of them, the lessons that the guys at Renaissance drew from the long-term capital experience is not to get too cocky, not to get too haughty, not to believe in your models excessively. So they do believe in their models. They let the trading almost entirely is done by their models, but they're looking over its shoulder and they realize markets are always changing and they don't double down like long-term capital did. And that was the problem with long-term capital. Theoretically, long-term capital, you can read about the history of that. If they were right, long-term, they would have been right. They just couldn't hold on long enough. And Renaissance realizes that, so they don't trade the same way.
It seems like Jim Simon's strategy, which is basically just hire the smartest people kind of regardless of what their specialty is. As a society, we're like so specialized and hyper-focused on certain things, but his thing was just, if you're smart, you'll figure this stuff out.
Yeah, it's very unique. It's among, again, there are a series of secrets, things they do differently than everybody else. And that's one of them, as you said, and I could have gone into a whole bunch of different ones, but they just hire talent. They don't need to fill a hole. We need a programmer. We need a code or whatever. They just say, you're super smart. We're going to hire you. You'll figure out a way to contribute. And frankly, it's intimidating for people who hire. They get there, it's office in Long Island, and they're like, what am I supposed to be doing here? But then they get in a room with others and they're all debating ways to improve their system. And it's an open system. That's another advantage and something very unique. Everyone can see all their code. Can you imagine even a junior employee sees all the code of the most secretive, successful hedge fund in history? It doesn't seem to make sense. And yet I explain why. These guys are unlikely to leave, and these are NDAs, and they sue, and also they hire academics. Academics are not going to go work for Goldman Sachs. They're going to go back to academia. And I don't think Jim consciously set it up this way, but he stumbled into a beautiful system. But yeah, they just hire talented people and they create incentives for them, and they say, go figure out a way to improve our models and our firm.
Who do you think was the second most important person behind Jim Simons to build Renaissance? There's a lot of others. When you talked about Bob Mercer, and was it Magerman, Axe? There's so many in the book. I mean, who do you think was the...
It's a great question. I mean, I can identify a few people. There's this guy, Sandor Strauss, who was early on in identifying data, collecting it, and cleaning it. Jim Simons didn't tell him to do this. That was Sandor Strauss. He was like the first data scientist. He realized the importance of data, and Jim wasn't against it, but again, Jim found really good people and created the right incentives. You could say Bob Mercer and Peter Brown, who currently runs the firm, they're the ones who figured out a way to profit from equities. There's no way Jim Simons would have been who he is without equities. You could say, as you said, this guy, David Magerman. David Magerman identified a glitch in the system. The S&P 500 was a static number in their system, wasn't updating, and David Magerman figured it out. And had they not, they would never have developed a way to make money in equities. It was a team effort in a lot of ways, a lot of quirky, odd, and interesting, unusual characters.
One of the other interesting things, I mean, kind of sad, but was Simons had with three kids, and two of them passed away fairly young. For a guy that's had so much success professionally, his personal life, he's a chain smoker. He's had some interesting tragedies in the family. To me, one of the larger takeaway messages was like, you can make a bunch of money, but that's just one aspect of your life. You had some people that left and came back and wanted to do other things, and like you were saying, they make some money, then they go and try to cure autism or something. What are some of the lessons of that we should take away from that you're trying to kind of convey to the reader?
Yeah, so I end off the book with the point that Jim Simons made his billions. He's worth about $28 billion, the greatest speculator in history. He made his money making predictions. And yet he can make predictions in the market, which is really hard to do. But in his own life, he was surprised left and right by tragedy. And yeah, two sons killed tragically, one in a biking accident, one in a scuba diving accident. He has another child with autism. And would he have traded all? I'm sure he would for the health and lives of his children. And that is one of the lessons. Life is really unpredictable. And even somebody who makes his fortune and his reputation making predictions can't do it. It's humbling. It's a humbling reminder to us all.
In your book, you write that it became clear to Mercer and others that trading stocks bore similarities to speech recognition, which was part of why Renaissance continued to rate IBM's computational linguistics team In both endeavors, the goal was to create a model capable of digesting uncertain jumbles of information and generating reliable guesses about what might come next. And that's exactly what you're saying. Basically, they were using kind of like an AI system to predict what is coming next. And as AI gets better, is there going to be more people that are going to be able to predict what is going to come next? And then when more people can predict what's going to come next, does it then make it more unpredictable?
It's a great observation. And yet they were doing generative AI before it was called generative AI. They were about, but both at IBM, this group of people, Bob Mercer and Peter Brown and others, David Magerman, were trying to predict the next word in a sentence. And to some extent, that is what generative AI is about, making just what are the odds, what are the chances of the next word, the next idea, predicting it. That's the basis of generative AI. And they apply that approach to investing, to trading. So you would think that the guys at Renaissance, more than anyone, would say, hey, all you need is generative AI to beat the market. And yet I've talked to some of those people over the last few months, and they're skeptical of the ability of AI to beat the market, and only AI, as opposed to using AI in a broader system, partly because markets are always changing. So the human language, English language, and other languages are changing. They're evolving to some extent, but not like markets. So it's more difficult, believe it or not, to predict markets, the future of the market, according to them and others too, than it is to do language prediction or AI and use AI for other means. So yes, everyone is convinced, including people at Renaissance, that you can use AI and machine learning to help inform your trading. But even the people at Renaissance aren't convinced that that's all you need.
Like you said, there's different styles. I mean, you can be George Soros or Warren Buffett or Paul Tudor Jones, Peter Lynch. I mean, you name them, they all kind of have a different style. And like George Soros, I mean, didn't he make most of his money from crashing the British pound? I thought was a
lot of it, not all of it, but yeah, a lot of it, yeah.
But a lot of it. And then he had a lot others that made a lot of money during those credit default swaps.
John Paulson, yeah, I wrote a book about him, yeah.
Who would you say would be your top 3 or 5 investors then? You'd have Jim Simons at the top. How would you put some of those guys? Because you had people that predicted the recession, or, I should say the housing collapse in 08. And like you said, Jim Simons, he didn't predict that at all. Not that they were necessarily looking for that.
Yeah. Well, if you're going to say traders / speculators / investors, because again, I don't consider Jim Simons an investor. He's not making long-term predictions. He's trading. But in terms of an investor, the top guys. So yeah, I wrote this book called The Greatest Trade Ever, and it's about John Paulson and about a few others who anticipated the financial meltdown in 2008 and made billions. John Paulson made $20 billion over 2 years, but he made some mistakes afterwards. And he was a singles hitter beforehand. It's not to say we can't learn from his remarkable trade. My argument in that book is that developing the thesis that the housing market was going to collapse wasn't even 10% of why we should give him credit. It's how to express the thesis. Very few people figured out how to use these credit default swaps and the right approach, the right amount of leverage. You can read about that in that book. And so we can learn a lot from that trade and from those people, and it's entertaining in a lot of ways. But I don't think John Paulson goes down as one of the greatest investors. Neither do any of the people that predicted 2008. To me, the greatest investors include George Soros, although he's a bit of a trader. True. There's a guy named David Tepper. David Tepper, I've always put on a pedestal. Maybe he doesn't get quite as much ink and credit. He's not as active. He invests for himself, but not for outside money. So he's more private now. You don't hear so much. He'll go on TV once in a while. But he made, you can go in the archives. I wrote a story about he made over, I think, $6 billion in 2009 betting on bank shares and bank investments right after the financial crisis. So he's a guy right up there. Buffett, obviously. Cohen is a little more of a trader type, but he's up there. There are a lot of Hall of Famers.
Do you have any books you recommend for people that want to learn about trading besides your book? What do you recommend to someone that's actually researched this and studies this?
Great question. I've looked. There aren't that many great. There are these books that have like a chapter on this investor and chapter on that investor. I'm not a huge fan of those books. They tend to be sort of hagiographies. Why this guy's so brilliant. I like the approach. I'm thinking about writing something about just looking at not so much the greatest investors, but the greatest trades and learning from each of the different trades and what we can learn. Because it's just a really hard market and no one's foolproof. But there are various investment books, but the classics, Buffett related ones are still great. There's a few others. I'm blanking on the names, but no real ones that you need to read kind of thing. Unfortunately, there should be.
How long did it take you to write and research The Man Who Solved the Markets, the Jim Simons book? It seemed like that would have been a couple years.
Yeah, it was a couple years, and it was stressful because they're the most secretive firm Wall Street's ever seen. So Jim and others were telling people not to talk to me, even as I was doing my research. I had to convince people to talk to me, both at other firms, rival firms, but even obviously at Renaissance. Why would you talk to me? You're making a fortune every year. You've signed an NDA, and I got to somehow convince you to talk to me. Thank God there were enough people who did. I think partly because they realized they were making history, and they wanted people to realize that they were part of something special and how it had developed. But yeah, it was a difficult process.
So I got two final questions. Where can people find you, get a hold of your books? And then the final question, why did you write the book? What's the take-home message that you wanted the reader to gain from writing the book on Jim Simons and Renaissance technologies?
So I wanted to answer the question, how did they do it? And it's something that's stumped Wall Street for years, individual investors, but also sophisticated investors. So I've gotten calls from all kinds of people, and people running the most impressive, biggest hedge funds in the world who bought the book and learned lessons from it. And again, sometimes the lesson isn't the formula. It's how to build a firm. It doesn't have to even be a trading firm, investing firm, any kind of firm. How do you get talent to work together? How do you create incentives? How do you get people on the same page? How do you hire the right people? So there are all kinds of interesting lessons to build a successful enterprise. I think you can learn from the book, but also as a trader, as an investor, who you're going up against, how to compete. You don't want to go up against Jim and his 300 PhDs. You want to try to do a different kind of investing. And you learn about markets, I think, from the book and the nature of markets and the mistakes we all make, behavioral mistakes, greed and fear, that kind of thing. So I think there are a lot of those kind of lessons. And in terms of me, I'm easy to find. I work at the Wall Street Journal. Email me. I love hearing people's comments, criticisms, constructive criticisms. I'm on Twitter often. You can find me there, LinkedIn. I don't do Instagram and things like that. And in terms of the books, Amazon, your local bookstore, often will carry my books. And feel free to reach out. I love the dialogue with people.
Thank you so much, Gregory Zuckerman, for joining us. And I just really appreciate you taking the time to join us.
Nice to be in touch, and I look forward to interacting with your audience.
That is it for this episode of El Podcast. And once again, if you guys aren't subscribed yet, please consider subscribing. And find us on Rumble, Spotify, and Apple Podcasts as well. We thank you all dearly for watching and listening. I will see you on the next episode.